Hey everyone, welcome back to Clipping Coupons with Jennison Fixed Income. My name is Alex Chansky, and I'll be your host for the show. Today I'm speaking with Adriano Taylor Escribano, a portfolio manager on the investment team here at Jennison Fixed Income. Adriano, thanks so much for joining me today. So Adriano is my manager here. I started out on the quant team with him a little over a year ago. And since then he's been promoted to portfolio manager. Adriano, do you want to maybe give us like a 30-second introduction about yourself and your background, kind of how you fit into the Jennison team here?
Yeah, of course. I'm a math background. I studied math in college and sort of in a meandering way ended up in structured products. And then when I was hired at Jennison, I was actually hired as a senior quant. And so what that involved was helping understand the risks in our portfolio from where are our active risks and understanding risk asymmetry from our active risks, and just getting a better feel and understanding of what those are and how to benefit from other trades and reduce downside risk on existing trades.
Cool. Okay, and how long have you been at Jennison for?
A little over 4 years now. I started in actually on Valentine's Day of 2021.
All right. So then the first official question I have for you here. Can you tell me a little bit about kind of a high-level overview of how a commercial mortgage-backed security deal is typically structured?
Yeah, I'll take a step back from actually the structuring of a particular CMBS deal and just talk general broad strokes on the CMBS market, and then I'll get into the structure. So we have to remember about structured products is the structure part is where all the subtlety is. And so I'm going to talk in general strokes here. But the market is bifurcated into two large segments. There's agency CMBS and non-agency CMBS. And then within that, there are pooled loan vehicles and single loan vehicles. On the agency CMBS side, you can have both pooled vehicles and single loan vehicles, and on the non-agency side as well. To give an example, for the agency CMBS portion, Freddie K's are typically pooled vehicles, so they'll have lots of loans in one deal. A Fannie DUS is generally speaking a single loan. And then on the non-agency side, you have conduit deals, which are pooled vehicles, are a vehicle of pooled loans. And then single asset, single borrowers, or SASB for short, which are single loans. Now, within each one of those, you can have structure. Now, the structure, depending on where you are, whether an agency CMBS or non-agency CMBS, the structure has a time component, so when do you get paid, and a credit component, meaning if you get paid, to put it generally. If you're up in the capital structure, so a lot of these will have a AAA tranche, you are more likely to get paid and are considered money good for the most part. And as you go down in the capital structure, the if part becomes a bigger component of credit.
Great. Okay, thanks. Which of those are the most common right now? What's like a typical setup in, I guess, maybe parts of the United States, or if it matters by geographic region?
No, that's a good question, because the market's actually changed a lot since rates have risen in 2022. It used to be, from, call it post-GFC, from 2012 onwards to about 2021, say, most of the market was conduit non-agency CMBS, where agency CMBS was a rapidly growing part of this commercial real estate loans within commercial mortgage-backed securities. And over that time, you had a growing segment of both single asset, single borrowers, and agency CMBS. And then post-COVID and post-Fed starting to increase rate with inflation and a very different rate environment than the last 15 years, you've had a growing segment of 5-year conduit loan deals, which didn't exist prior to 2023, and also a larger component of 5-year agency CMBS.
And can you remind me, what are the conduit deals exactly?
Yeah, conduit are pooled vehicles of loans. So you have, say, a typical deal will have anywhere between, say, 25 and 65 loans, roughly speaking. And there'll be loans to anything between, retail. So it could be a mall, it could be a strip mall, it could be hotels, it could be self-storage, it could be multifamily or office, industrial, you name it. It's probably in there. And geographically speaking, I know you asked about that, it could be anywhere in the US. Sometimes they include Puerto Rico, sometimes Canada, but it's generally a very smaller part of the pools.
Cool. Next up, we have a big question about tariffs and the overall political environment. I know some of the news on that kind of changes daily and weekly. We're recording this in early June here. Yeah, just checking in to see how tariffs and the current political environment are going to impact CMBS deals from our perspective here at Jennison, I guess.
Yeah, that's a huge question. And I'm going to try and avoid talking about specific market volatility because that can change in a tweet. And, while we're talking here, something could have happened with anything. It just takes a tweet these days for markets to change very dramatically. So from a fundamental perspective, the big question mark is economic uncertainty. Sentiment has fallen. And so the question is, do we enter some sort of a recession? And if we do, how bad is it? And around that, let's say we do have some sort of a recession, it would be bad across the board. It doesn't matter what property type you're in. It doesn't matter what geography you're in. It's going to be, from a fundamentals perspective, bad. Now, what we tend to focus on is up in the capital structure and higher quality loans, more diversified pools, so you're mitigated from idiosyncratic risk and mitigated from losses, just given how you are in the capital structure versus somebody who's subordinate. Mm-hmm. So there's some amount of mitigation there when it comes to riding out a storm like a recession. Now the big thing is tariffs since April 2nd, Liberation Day. And if reducing the trade deficit is really the ultimate goal of this administration, then it's going to have a negative impact on industrial properties, particularly around ports, just because we're going to be importing fewer goods. And there's been a huge boom in demand and construction of industrial properties. I remember seeing a couple years ago in a conduit deal alone on something called IOS, which is called indoor-outdoor storage. These are typically around ports. So that sector is going to be more impacted by a reduction in a trade deficit or in trade in general, because typically those are basically parking lots for the containers you see on the big ships. Mm. The other thing is, retail will be impacted, and that's going to be segment specific. Consumer behavior will shift as prices move up and down for different goods. I can't pretend like I can predict what consumer behavior will how it will change and what specific segments will benefit and what won't. But I know it will change, and the retail segment will be impacted. And then hotels. We've already seen this anecdotally and through certain data. There's less travel. Some of it's foreign, some of it's domestic. And so hotels will be impacted, particularly in areas that are that rely a lot on foreign demand for like hotel usage.
Yeah, that makes sense. And then I just want to circle back on a question I had a couple minutes ago from something you said. I think we were talking about conduit deals, and you were mentioning that most of the time here at Jennison, we try to stay with the higher credit tranches. We try to stay with AAA, that kind of stuff. And then I just wanted to clarify, that's because the reason that's safer from our perspective in terms of idiosyncratic risks is so that if one property goes under and isn't able to pay their debts, we still get almost all of the money back. Is that the right idea?
Yeah, so a typical conduit structure will have 30% credit enhancement at the AAA level. So that means from a loan perspective, you have 30% of bonds that are underneath you that will have to take losses before you take a loss.
Oh, wow. Okay.
And so, let's say you have a pool has $100 worth of a loan on it. Each one of those loans can take a 70% recovery if they all defaulted before you start to incur losses.
Great. And then going back to the geographic specific, have there been any parts of the country that have been like particularly high risk or have maybe already started seeing extra losses from things like tariffs and the current political environment?
I think this stuff will take a little bit of time to play out. Commercial real estate tends to be a slow-moving machine. Sometimes it's a slow-moving train where a lot of equity holders make a lot of money, and sometimes it's a slow-moving train wreck. And ultimately, a lot of times you don't know which one of those it is until until you're out of it. But from a geographic perspective, I would say kind of DC office has been in the crosshairs for a variety of reasons. You have the office segment that's been in pain basically since coming out of COVID. And then you had the headline risk around Doge. So there was a lot of talk around how much DC office will still be around in 6 months after all these cuts take place. But again, it's going to take time to take its effect. And whenever you participate in CMBS, you got to be mindful of GSA exposure. So that's the government entity that does all the leasing for its agencies. Yeah, I would say the last thing to mention about this administration and question marks is the big elephant in the room is around GSE sponsorship. Fannie and Freddie are currently in conservatorship, and they have been since the end of the financial crisis. Under Trump 1.0, you had Mark Calabria, and he was very hyper-focused on carving out the multifamily segment out of the GSEs. Trump 2.0 has been a little bit more guarded in exactly what they want to do and how they want to do it. But it's the big elephant in the room in terms of how that's going to play out. The multifamily segment of Fannie and Freddie is a $1 trillion debt market. It's very large, and it would have large implications on the lending market for multifamily across the U.S. I'm going to get the numbers not exactly right, but I think there are about 40% of the multifamily lending in the U.S. On that note, of the agency CMBS that we participate in, we tend to favor Freddie K's. And the reason for that is not only are they pooled vehicles, so you benefit from mitigation from idiosyncratic risks, like you brought up earlier, but they also have structural enhancement. So they actually get a AAA rating without the wrap from Fannie and Freddie. In this case, Freddie Mac. So when you had the downgrades of Fitch and Moody's most recently, most of those structures weren't impacted by the rating downgrade because they had a rating that did not take into account the wrap by Freddie Mac.
Oh, interesting. So you're saying the Freddie K products kept their AAA ratings?
Most of them, yeah.
Most of them.
Like I said earlier, there's always subtlety in structured products, and some of them didn't have that structural enhancement that gave them that explicit rating.
Is that just because they're good deals? Is that just because they're buyers with good credit? Is that the idea?
It's just the way they're structured. When the sector really started ramping up post-GFC, they tried to mimic to some extent the structure of conduit. And so a lot of these deals have, between 15 and 20% subordination, so structural enhancement at the AAA level.
Okay.
So the rating agencies will give them that AAA rating with that amount of enhancement.
Okay. Do you have any concerns or any trends that you're watching here? Any opportunities that you're looking out for as we start to slowly shift into the second half of 2025 here?
Yeah, concerns are plenty. As a fixed income investor, you're always looking out for the downside. One of the things that I've picked up on and have seen more recently is the leverage points on the whole loans for a lot of these, particular in single asset, single borrowers, but it also happens on the underlying loans for conduit, is the underwritten NOI. So that's the net operating income that the underwriters will associate to the loan, that they underwrite to, will tend to be higher than, say, a trailing 12-month operating income or net operating income. And it ranges between 10 and 30% above trailing 12-month. And so it's just, something to be mindful of is some of these loans are underwritten to income that has never existed yet, or it's based on a business plan that is coming to fruition. So it basically relies on the operator to succeed in what their business plan is.
And then on the flip side of that, any opportunities that you want to talk about here?
Yeah, we have had opportunities both in the conduit space and in single asset, single borrowers. Single asset, single borrowers tend to trade wide versus conduits or single A financials. But you got to be careful about this cheap for a reason too. SASB are single loans, and so even at the AAA level, you kind of have to underwrite to the whole loan because it's a single loan. You have to look at the leverage up and down the capital structure and say, does this business, this property at this leverage market or this leverage point make sense? Because you're levered to this one individual property, you can have very unfortunate outcomes. And there are about a dozen single asset, single borrowers out there that are in trouble currently. As a AAA buyer, you want to be careful about being in those deals that run into trouble because it's such a binary outcome because you have exposure just to one loan.
Yeah, that makes sense.
And then outside of SASB, in the conduit space, we found better opportunities with more diversified pools. So pools with more loan count, more geographic distribution, more property type distribution. And so we found that it limits downside and negative outcomes to idiosyncratic events. Things like high retail concentrations were the norm prior to 2015. And then when retail had a crisis, any deal that had a high number or high percentage of retail exposure started to trade a lot wider than any other bond. And I'm talking about the AAA level. Subs traded much wider. And then office had a similar experience. There were, at the beginning parts of COVID, going from 2000 or even a little bit prior to COVID, with 2019 going into 2020, 2021, there were certain deals that had very high office exposure, and the market loved them. And the reason being is because they didn't like retail at the time. Mm-hmm. And in COVID, they didn't like hotels either because nobody was traveling. And so what happened was everybody loved office because they had long lease terms. So you had these deals that had high office concentration because people wanted office. Well, lo and behold, probably didn't take more than 12 to 18 months. People started to dislike office. And then any deal that had a high office concentration started to trade wide. And so, again, you got to look at diversification, both geographically and from a property type perspective, because we found better downside protection with those types of transactions.
Okay, great. Last fun question I have for you here. If you have any movies, shows, or books, anything like that you've seen or read recently that you want to talk about and let everyone know that they should go check out.
Yeah, I was warned about this question beforehand, and I have 2 young kids at home, and so most of my reading are Richard Scarry books and Bluey books right now. I figured you probably didn't want to talk about that. It's the only thing I could think of. But the one thing that I am reading right now is an encyclical written by Pope Leo XIII from 1891 called Rerum Novarum.
Is that what you're reading to the kids for bedtime?
No. I think they would kick me out of the room if I did that. But I do find it interesting. It was written in 1891, so at the turn of the century, and on the heels of the Industrial Revolution. And it's an interesting. I've only just started reading it, but I've enjoyed it so far. It's sort of a interestingly, a defense of property rights written by a Pope, which is kind of interesting. And I think he hints at this later on, and I haven't gotten there yet, but it's also a defense of the dignity of a human being. So I look forward to reading more of that and seeing how a defense of property rights turns into a defense of the dignity of a human man too.
Cool. Yeah. I'm curious to hear all about it when you get there. Anything else you want to share with the people before I pause the recording here?
No.
Okay, that's all right. Thanks so much for doing this, Adriana.
Of course. Yeah. Thank you.